Welcome back to the To Buy or Not to Buy series. This is the third and final part as earnings season for the second quarter of the calendar year 2025 has wound down. We're looking at 5 more businesses and what their buy prices are. These buy prices are based on my own discounted cash flow, dividend discount model, and exit multiple pricing. Please watch part 1 of the series for a breakdown of how I find the final buy price of each of these. And for a few of these businesses, I will show you the details of their buy prices. We are looking at 5 businesses today. We are looking at Meta Platforms, Cadence Design Systems, Airbnb, MSCI, and Fair Isaac.
But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market.
Starting out with Meta Platforms, they had a pretty impressive Q2. They now have a market cap of nearly $2 trillion, so they are set to become the 7th American $2 trillion market cap business, closing out the day at $765.70. And like I said, they had an impressive Q2. Post earnings, they'd had an over 11% pop in their share price, up to about $773, but had been pretty flat since that point, and that's where we're at today at $765. And based on that price, the market is implying a free cash flow growth here of 11% over the next 10 years. However, I'm a bit more pessimistic than the market here. I have a buy price of $645, and that is based on a 20% margin of safety. So Meta would have to come down almost 16% for a viable entry point into the business. And I'll be honest, this is a business that I do think is a little bit risky in the sense they really have one revenue stream, which is their advertising dollars. And while they're growing that business quite nicely, many other parts of their business have not proven yet to be reliable revenue growers. Namely, the Reality Labs segment, which is where a lot of their virtual reality, augmented reality, mixed reality type products are housed, and none of those have shown any real promise in the market. Maybe their Ray-Ban glasses. We shall see how that works out. Next, we are looking at Cadence Design Systems. Cadence Design Systems is a business I would love to own personally. They are within the semiconductor ecosystem, and what they do is they provide software that designs the semiconductor chips of the new world here. So they are a vital component of the semiconductor supply chain. They have a $98.6 billion market cap. They closed out today at $361.77. And that means the market is implying stellar free cash flow growth over the next 10 years of 17.1%. My buy price, however, is at $270. And I'll be honest, this is at a 10% margin of safety. I'll show you the details here in a second, but this is a business I've been waiting to come down for a reasonable price, and it simply has not. They would have to come down a staggering 25.4% for a good entry into this business, and it seems like we're a long way from that because this is a highly profitable business and a vital business to the semiconductor supply chain system. Cadence Design Systems, or CDNS, has a staggering PE ratio right now of 97.8. Their forward PE sits at 90.8, both of which are far higher than their 5 and 10 year average. Like I said, that reverse DCF free cash flow growth is at 17.05%. My free cash flow growth for the base case is at 15.6%, and it ranges from 12.1% on the bear case up to 19.1% on the bull case, resulting in a DCF for the bear of $244.53 up to $421.29 for the bull case. Their current operating margin is at 30.7%. My bear operating margin by year 10 is at 34%, and the bull operating margin by year 10 is at 38%. But where Cadence is brought down a little bit in my own valuation is their exit multiple. I'm using comps here of Salesforce, Uber, ServiceNow, Intuit, AppLovin, Autodesk, and Workday. And the reason it's brought down is because the average of those PEs there is about 70, whereas Cadence is at 97.8. So you can see they have a much higher PE ratio than their peers. And because of that, without any margin of safety, we have a buy price of $303.97. The 10% margin of safety of $273.57 buy price and a forward PE of 68.7. That would bring them more in line with their current peers. And that's where I'm getting my $270 buy price from. Seeing how this market has been reacting to businesses that either miss earnings or provide poor guidance, it's very possible they could have a sharp hit to their share price in Q3 if they don't perform well. Airbnb has been a business of stagnation, at least in the stock price, the last 3 years or so. Their market cap sits at $75.8 billion. They closed out the day at $123.81. And get this, the market is implying negative 0.6% free cash flow growth over the next 10 years, which justifies this $123 price. Is there a scenario where Airbnb actually loses 0.6 free cash flow per year over the next 10 years? Possibly. Is it likely? I don't think so. I have a buy price of $140, and that is a 13% upside from today's price. Airbnb, while their growth has slowed a little bit, they are reliable in their revenue growth and their earnings growth. And from a free cash flow generation perspective, they're highly free cash flow generative. So we should expect to see good returns in this business going forward. Hopefully the market will catch up. Airbnb has a PE ratio of 30 and a forward PE of 30.2. They haven't traded long enough to have a 5 and 10 year average here yet. But like I said, that reverse DCF for the free cash flow growth, the market thinks they're actually going to decrease their cash flow by 0.6% per year over the next 10 years. I'm a bit more optimistic at 6.6% growth annually, up to 9.8% on my bull case, and as low as 3.5% on my bear case. Regardless, I think there's upside all around here. That on the bear case, I have a DCF price of $158.12. a base case price of $198.87, and a bull case price of $250.86. My exit multiple sits at $127.34. I'm using comps of Booking Holdings, Expedia, and TripAdvisor. That means without any margin of safety, I have a buy price of $175.66 with a 20% margin of safety. That is where I'm getting my $140 buy price, a forward PE here of 34.3. I bought into Airbnb late 2024, and I am slightly down in my position, about 6%. Yet all the fundamentals point to the fact that they should be growing soon. They have another revenue stream that's expected to bear fruit starting in 2026, Airbnb Experiences. We shall see how that plays out. But all in all, the history of this stock has pretty much been flat the last 3 years, despite solid free cash flow growth of 25.5% annually. They're also doing a good job of growing their margins at over 80% gross margin. Their operating margins steadily ticking up over 22% now. And they have a free cash flow margin of nearly 40%. So again, I think this is going to be a stock that will pop. When it pops, I just don't know right now. But I'm holding on anyway. Next, we're going to look at Fair Isaac, or FICO, of the famed FICO score. They have a market cap of $37.1 billion. They have had a pretty rough year. Right now, they're down 22.3% year to date. On a 1 year basis, they're down 13%. But that doesn't change the fact on the last 3 years, they've grown their share price 50.7% annually. Their current share price is at $1,546.56. That means the market is implying free cash flow growth here of 15.3% per year over the next 10 years. Now, FICO did have a huge run up to over $2,300 per share, and they hit that high in late of 2024. I did a deep dive into their earnings after the Q2. I encourage you to check that out. I have it linked in the description below. But from that high to the low of $1,311.26 that they hit in early August post earnings, that is a loss in their share price of 45%. So when they were hovering around that $13.11 to $13.50 range, I was lucky enough to pick up some shares and build a decent sized position in my portfolio. They have been recovering nicely since that point. On a 1 month basis, they are up now 17.1%. So now to get back to my buy price of $1,340, they would have to fall about 13.4%. And FICO did fall because there's a lot of trepidation in the market around an alternative to their highly monopolistic FICO score. It's called the Vantage Score 4.0. Again, check out that video for what that means to FICO's business. It's essentially an alternative scoring method for lenders to use to score mortgage borrowers on their ability to repay their loans. I explained in that video why it won't affect Fair Isaac the way the market currently believes it will. And my thesis there is that the alternative scoring method will become something like what we see with S&P Global and Moody's, where lenders will want to use multiple scores to assess a borrower's potential to repay their loans. And that would only strengthen FICO's position in the market. In all honesty though, my FICO buy price of $1,340 is about a 5% margin of safety. At the end of the day, FICO trades at a premium. Their PE ratio is back up over 60. So you're going to have to take those opportunities when FICO does dip seriously and buy when that happens, because it's not going to last for long with this business. Last, we're looking at MSCI. MSCI is one of my favorite businesses. They have a $44 billion market cap and they closed out the day at $569.16. They are down 5% year to date. Honestly, they've had quite a choppy 2025, and in my view, for no real reason. Their earnings have been solid. They have a dominant market position in their index benchmarking business, and they're highly profitable. They have operating margins over 50%. The market seems skittish, though, about their subscription retention revenue, which really, if you watch the video I did on their Q2 earnings, did dip a little bit so far in 2025, but it's higher than the historical norm. So at that $569 share price, the market is thinking that MSCI will only grow their free cash flow over the next 10 years at 9.7%. My buy price is at $535, so they would have to come down about 6% to justify buying more MSCI. MSCI has a PE ratio of 37.7, a forward PE of 35.3. Their PE is far below their 5 and 10 year average, where their forward PE is below their 5-year average and right at their 10-year average. I mentioned before, the market believes their free cash flow will grow at 9.7% over the next 10 years per year. My base case has them at 9.1%. My bear case has them free cash flow growing at 6.5% up to 12.8% for the bull case. And that results in a bear price here of $418.17 for the DCF up to a bull price of $730.37. MSCI pays an excellent dividend and a growing dividend at that. It's currently at $7.20 per share. Last year, it grew 16%. My bear growth rate for the dividend is at 12%, up to 16% for that bull. So that's where I'm getting a dividend discount price of $645.60 for the bear, up to $917.69 for the bull. So the valuation powered a lot by their dividend discount model. Remember, I am only weighting this by 25% though. The exit multiple is at $501.32, and my comps are S&P Global, Intercontinental Exchange, and the CME Group. So with no margin of safety, MSCI has a buy price of $593.89, and with a 10% margin of safety, I think this is an incredibly reliable and safe business. They have a monopoly, essentially, more on the international side of their index benchmarking. They do compete with S&P Global in the States, effectively creating a duopoly. However, with a 10% margin of safety, they buy price at $534.50. That's where I'm getting my $535 buy price from, and a forward PE of 33.2. This is an incredibly profitable business. Gross margins over 80%, operating margins over 50%, and free cash flow margins nearing 50%. If they do hit their bull case numbers, I am expecting free cash flow margin to grow to 54.4%. MSCI, I think overall, is an excellent and reliable business. And every single time it dips into my buy range, I always buy more. I love this business and I love buying more shares of it every chance I get. So that wraps up our to buy or not to buy series. This has been the third and final part 3. I hope you enjoyed it. My next couple videos I have planned are Adobe once their earnings drop later this week. And I want to dive into the Google decision that has seemed to unlock Google's potential and has been letting their share price close at all-time highs seemingly every day since that decision.
Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.